What's up, you guys? I'm Dan, this is Frugal Not Cheap, and today we'll look at where to park our cash. So there are many options for how we might park our cash, and today we'll take a look at some of them. But first, we'll look at why we're doing this. Basically, it makes sense to match our tool with our purpose. So first of all, there should be a good reason why we're not investing these funds. And a very good reason why we might not be investing them is because of our time horizon. Investopedia says that an investment time horizon is the period of time one expects to hold an investment until they need the money back. Time horizons are largely dictated by investment goals and strategies. Just like I was talking about, we match our tool to our purpose. For example, saving for a down payment on a house for maybe 2 years would be considered a short-term time horizon, while saving for college would be a medium-term time horizon, and investing for retirement a long-term time horizon. The idea here is that the longer the time horizon, the more risk we can afford to take. This will give the assets time to grow, and because it's a longer time horizon, then we don't need to count on the market being strong on at some particular date when we're going to need these funds. In other words, it wouldn't make any sense to be investing our emergency fund in very aggressive assets if we're going to need that emergency fund very soon. And because let's say the market corrects and it's like, down 30% or something like that, it's not a great time to be trying to access our emergency fund. In general, we might think of short term as something like 1 to 5 years, medium term as 5 to 10 years, and long term as 10 years and more. For a short term horizon, we definitely want to have low risk assets, again, so that we have access to them when we need them. For the medium term, we might do more of a mix of low risk assets and some higher risk assets in order to get a bit of growth in there. And for the long term, again, that's where we can be the most aggressive in our portfolio. Exactly how aggressive will depend on our personal risk tolerance. So what we're talking about today are the low risk assets that would make up the strategy for a short-term investment horizon. Where would we accumulate the savings for, say, the house down payment? Where would we put our emergency fund? How about a sinking fund for vacations and other regular expenses? So we've got a bunch of options, but for me, I definitely don't want to be having my money losing purchasing power over time due to inflation. So I don't want to park it at a place that has zero or near zero rates like a lot of brick and mortar banks. I want to be looking at alternatives that are going to provide a higher yield and at least keep up with that inflation, if not exceed it. So 4 of those options we'll talk about today are high yield savings, money market accounts, certificates of deposit, and money market funds. First, we'll look at high yield savings, and I have done a video sort of just about this topic. But the quick summary is that these are FDIC insured, so you don't have to worry if the institution goes under. There can be a bit of a delay in accessing your funds if you're using a high yield savings account from an institution that doesn't have a checking account that you're also using. So let's say you had your savings at Ally, but you're checking at Chase or something, then it would take a little bit of time to make the ACH transfer from one to the other. And the other downside to these high yield savings accounts, or to really savings accounts in general, is that those transfers, the number of transfers you can make in a month, are limited. But rates are quite good, especially compared to brick and mortar. And if you pick something like Capital One or Ally, you could have a checking account and a savings account with them, so transfers between them would be basically instantaneous. Here we can see some recent rates for the month of October 2023, anywhere between 4.25% to just over 5%, as compared to essentially zero for some of the brick and mortar varieties. A lot of options out there. You can do some research and figure out which one works best for you. Ones that I've used personally in the past, again, have been Ally and also Capital One 360. And way back in the day, I used E-Trade as well. Next, we've got money market accounts. These are similar. They're also deposit accounts, but one kind of key quirk or benefit to them is they can kind of act like a checking account too, in the sense that you can have a linked debit card and you can also have checks to write out of it. These are also FDIC insured, or some credit unions, there's a kind of a different insurance as well. But these money market accounts typically can sometimes have a higher minimum balance requirements, maybe some fees and that kind of thing. Not all of them, like Ally doesn't have a minimum balance requirement. And we can see here that rates can be a little bit higher in exchange for those minimum balance requirements. CIT Bank requires $5,000, but the rate is over 5%. Ally's money market account, so we're kind of doing apples to apples here, has a yield of 4.4% annually, whereas we saw earlier that the savings account is at 4.25%. Next, we've got certificates of deposit. These are also sometimes known as time deposits, but basically we're locking up a little bit of our money with the bank. So there's some preset amount of time that the money's locked up, and also the rates are locked up on that money. So we could do like a 3-month CD or a 6-month CD or a 12-month CD. Of course, the higher the time horizons are, the higher the rates tend to be. These are also FDIC insured, and what we can do in order to mitigate sort of the risk of interest rates fluctuating either favorably or unfavorably is to have what's called a ladder of CDs. In other words, we can have a mix of different investment horizons and then kind of keep reinvesting as things mature. In general, though, CDs are going to make more sense at times like now when rates are at historically sort of medium to high levels, medium right now, rather than when rates are near zero, because, well, they really have very little room to fall and much more room to rise. So why would we lock in, say, a 12 or 24-month CD at 0.1%, right? This doesn't make a whole lot of sense. One thing to keep in mind is there can be penalties for an early withdrawal. So if this is an emergency fund, the emergency happens, you need to get access to your money. That penalty could eat into some of the interest that you had earned to date. But they generally don't eat into your principal, so it's not a big concern there. But it is kind of a downside relative to, say, a high yield savings or a money market account, where you'll be able to access the full value of what's in the account at that moment. And then finally, we have money market funds. So these are different from money market accounts, which are deposit accounts. Money market funds are mutual funds. There's also some ETFs that can kind of mimic what they do. But here we're talking about investing in a mutual fund that holds the low-risk assets that are appropriate for our short-term investment horizon. Things like short-term government bonds, high-yield corporate debt, kind of the overnight lending interbank, that kind of thing. Now, there is in some ways more risk here. These are not FDIC insured because, again, these are investment vehicles. And as investment vehicles, it's also possible for them to actually lose money against, so you could actually lose your principal, or what's called breaking the buck, where $1 in the money market fund becomes less than $1. This has happened a few times, famously when the when Lehman Brothers collapsed. That was one time where some funds went to like 97 cents on the dollar. But these events are quite rare, and so money market funds are still perceived as relatively quite low risk. As a consequence of this risk that's in there, though, there is a compensation in terms of the return. So yields can be a little bit higher, although we want to keep an eye on expense ratios as well and make sure that the net is still beneficial. There can also be a minimum investment amount for the fund, so that's something to keep an eye on also. But on the positive side, some of these are also tax advantage, so that could be useful. Personally, I'm using SWVXX, which is Schwab's money market account. As you can see here, the 7-day yield is 5.25%. There's an expense ratio, I think it's about 0.35%, so net we're still in the high 4s. And because I have my Schwab investor checking as well, then it's really quick to, if necessary, sell some of this mutual fund and then move that cash over from my brokerage account to my checking account in order to meet whatever emergency might come up. In the future, because this is a mutual fund and it can be difficult to hold and trade mutual funds while you're living abroad from the United States, I will probably go to an ETF, something like SGOV, SGOV. This is basically an ETF with short-term government securities, so very similar yields, but the ETF version instead. So there you have it, 4 different options for parking your short-term cash, things like an emergency fund or house down payment, etc., etc., or a sinking fund or something like that. As always, do your research and figure out what's going to make the most sense for you. Hope you found today's video helpful. If you did, please hit the like button and consider subscribing. Thank you very much for watching, and I will see you in the next video.